Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and glad to have you on board with us, as this time we're going to be reviewing the WASDE numbers that came out from USDA and see what kind of impact they may have now that the numbers are all out. We'll see what lies ahead. I have Dan Manternach with me. He is with Comstock Investments, and I want to remind you to be sure and like, subscribe, and share this video with others so we can spread the good news about what's been talking about here in the ag industry. Dan, thank you for joining us here. A few surprises included in that report. If you would, I want to walk through these numbers with you and get your take on this.
Okay.
So first off, I think you wanted to cover the U.S. ending stocks. Is that right?
Yeah. Usually the February WASDE report is a yawner because the supply side of the balance sheet is fixed, and the only thing that can change is usage. And usually in February they don't change the usage figures, whether it be for ethanol for corn or crush for soybeans or the exports, all that much. But this particular report, there was a wide range of trader estimates of changes for usage coming up, and that was reflected in the ending stocks. What we got were, unfortunately, the U.S. balance sheet numbers were all pretty well uniformly bearish. When I display this for clients, I like to use kind of a color coding system. So those who are following along with me, if you just look in the left-hand column under the actual numbers, if the number's in red, that means it was a bearish number. And if it's in black, that means it was kind of neutral. And if the number is green, that means it was a price-friendly number. Well, on the U.S. balance sheet, all three were bearish. I mean, the average trade estimate was looking for the corn ending stocks to be 2.148 billion bushels, down a little bit from January at 2.162. But the range was huge. The range from 2.06 billion to 2.28 billion. Well, look at the number where it came in, 2.17. It came in a lot closer to the high end of the range than it did the low end. And that's why the market reacted negatively upon release of that number. In soybeans, it was particularly bearish. I mean, holy cow. The average trade estimate was that ending stocks would come in at 284 million bushels, up just 4 million from last time. And the range was from as low as 284 to as low as 245 to as high as 312. Oh my gosh. Look at the actual number. 315. They lowered the exports significantly because we just haven't been having exports stay on pace. And so to have the actual carryout come out above the high end of what the trade was expecting indicated why the market reacted quite bearishly at first. And it was the market really jerked everybody around today, because before the USDA came out, CONAB came out with their number. CONAB is the equivalent of USDA in Brazil. And CONAB came out with a soybean number that was a lot lower. But we'll get to the South America stuff later. I want to stay with just the U.S. right now. 315 million bushel carryout, above the high end of trade expectations. On wheat, it's in red because it was above the average expectations, but that's only mildly bearish. I suppose I should have made it pink instead of red. They were expecting 648. It came out at 658. The range of estimates, however, was from as low as 625 to as high as 662. So the reason I put it in red is that the actual figure was towards the high end of the range of expectations. So bottom line is the U.S. balance sheets came out uniformly price negative, but particularly so for soybeans.
Well, let's take a look. Also, you mentioned the South American production, and to me, that was probably the biggest surprise of the whole lot, wasn't it, when USDA didn't bring their number down much?
Exactly. Well, that's what jerked the market around, because first, CONAB came out with their number first, and they were at 149 million bushel for the soybean crop. I mean, our company, we're at 145. I mean, we're near the low end of, and we're down. We've got operations down there, and Matthew's been reporting on this regularly. But for CONAB to come down as much as they did, under 150, that's what caused the market to turn around and actually was up 10 or 15 cents for a while before the USDA WASDE came out. And it was up on the CONAB numbers. But then USDA comes out and whacks it with that big number. They only came down 1 million tons to 156. And the average trade estimate thought that even USDA, as conservative as they are, even USDA thought that USDA would come down around 152.5. And the range of estimates was as low as 148 to as high as 157. And like I said, CONAB came in at 149. We're at 145. USDA comes out and only knocks theirs down 1 million tons, 156. Only 1 million tons lower than last month. And that's what really hammered the soybean market when it first came out. What's interesting, however, I looked at how the markets closed, and the market came back to close on the plus side. Well, that's a very significant thing, because what it tells me is that on the chart, it's going to look like an upside reversal day. And our clients well know that often markets bottom on the most bearish possible news.
Mm-hmm.
And that's when all the bearish news is in the market, and the trade concludes, well, it can't possibly get any worse than this. And when USDA came out at 156, that was the trade's way of saying, it can't be any worse than that. And you know what? The trade started to believe CONAB. They said, you know what? If they're equivalent down there, they're down there. And they say it's 149. If we have to choose, who are we going to believe? We're going to believe CONAB, or are we going to believe USDA? The higher close today tells me that the trade decided, you know what? We've been getting all kinds of private estimates well under 150. Even CONAB is under 150. So let's just ignore USDA. And that's why we came back for a higher close. That's very significant. It's going to look good on the charts. I hope we could follow through tomorrow.
Talked about this on our podcast yesterday, the fact that we didn't know if the report could be bearish enough to continue that downtrend. It's like it ran out of bearish news.
Well, it got a dose of bearish news, but the market didn't believe it. In the end, what matters is how did it close? And beans closed on the plus side. So the market decided we've got to believe one or the other. We're going to believe the private estimates, and we're going to believe CONAB, because USDA is famous for being conservative anyway. And they were just ridiculously conservative with that number, only not knocking it down 1 million tons from last month.
I just wondered if you saw anything in the Argentina numbers.
We'll stay with Brazil for now. On the corn side, 124, neutral. The trade was looking for 123.6 compared to 127. This is Brazil's corn versus 127 last month. Came in at 124. Okay, up 400,000 tons from the average trade guess. That's a price neutral number, and that's why I put that number in black. The range of estimates was 115 to 127. And so it's well within the range. Okay, now Argentina. Both of those numbers are in green. That was a little bit of a balance for the bearish soybean number from USDA, because they came out putting the Argentine corn crop at 55 million tons, exactly the same as last month. And if you look at the range of trade estimates ahead of it, the range was from as high as 57.1, and the low end of the range was 55. And that's where they came in at, is 55. Same as last month. On Argentina's soybeans, 50 million. The range was 50 million to 52 million. So again, for Argentina, they came in at the low end of the range, just leaving it the same as last month. So the Argentina numbers were actually price friendly, but the Brazil number was super bearish for beans and neutral for corn.
So what does this all mean when you look at the global ending stocks? Put this all together for us, would you?
The corn number was neutral. The trade last month, global corn ending stocks were 327.1 million tons. The trade was looking for them to come down to about 5 million tons 325 was last month. The trade was looking for them to come down about 3 million to 322.1. Or 323.1, and they came in at 322.1. So actually, the global corn ending stocks actually on net, counting Brazil and Argentina, The global corn index stocks came in a little bit below the average trade guess. And the range of estimates was as low as 311 million to as high as 327 million. So some people actually thought that USDA would go up on corn by 2 million, and instead they came down by 3 million. So that was right in the ballpark of trade expectations. Soybeans, there you go. Global ending stocks at 116. And that was all that Brazil number. The trade had thought that the global soybean stocks would come in about 112, down from last month. The range was as low as 109 to as high as 115. And this is not just Brazil, this is global. Global ending stocks came in at 116, above the high end of the trade estimates. So the Brazil number was bearish, and it just poisoned the well for the global stocks number on soybeans. It was unarguably bearish. And once again, so the Brazil number was bearish, the global stocks number was bearish, and yet the soybean market managed to close higher today because they're not buying it. They're more trustworthy of the CONAB number of under 150. Turning to wheat, it was price friendly. The average trade estimate for global wheat ending stocks was 261.1. It came in at 259.4. The range of estimates was 257 to 271. So the wheat ending stocks came in at the low end of trade expectations at the global level.
So in summary, you're thinking soybeans actually saved the day at the end of the trading session with technically a fairly positive close, but the wheat may have opened another leg lower, maybe?
Yes, that's exactly right. The fact that we made new lows in the beans and came back to close higher, I haven't seen the chart, but I know what it's going to look like. It's going to be what technicians call an upside reversal day. And to close higher on bearish news, I mean, there's an old market adage that if a market can close higher on bearish news, it means all the bearish news has been dialed in. And that's what I think we saw in soybeans today. At least that's what I hope we saw in soybeans today.
Now, what about on corn? Did they make a new contract low again?
It did make another new low today, and the question is, how low is low? The problem with commodities is that prices always have to, when we're in surplus, and we're in terrible surplus with corn, with that huge ending stocks figure. And classic economic theory says the market has to drop to what they call market clearing levels. In other words, prices have to drop low enough that it discourages production and encourages consumption. But corn has been telling us it's not at the market clearing levels yet. And you only get a bottom when you've run out of willing sellers. And we may have run out of willing speculative sellers, although there's no evidence of that yet. The funds just keep selling and selling and selling. The trend is their friend. A fund manager will just say the trend is down until it isn't, and put it like that. But the problem is we have potential willing sellers as farmers. Farmers are holding on to a lot more of last year's crop than they normally do at this time. And seasonally, you often run into farmers selling pressure ahead of the 1st of March. Land payments are due, rent payments are due, just to raise some cash flow. And so, and the trade knows that. So that I'm hesitant. I'll be very honest with you. I've already thought the lows that corn were in like 3 or 4 times and been faked out 3 or 4 times, because it just seems like the market is so oversold. I mean, it's scraping. The oversold indicators are like at zero, about as oversold as they can get from a technician's point of view, and yet the market keeps going down. And so you raise a good question. What is it going to take for corn to bottom? And what it's going to take is for the market to just stop going down, because funds who are heavily short, they don't need bullish news to decide to take profits. Funds could take profits just on the lack of new bearish news, and just if the market stops. In other words, if the funds stop selling and they notice that nobody else is selling, that's what can trigger the short covering by the funds. So the best answer that I can give you is what will make this corn market bottom out, it's when the funds decide they've enjoyed the ride for all they can get out of it and decide it's time to ring the cash register and start lightening up on those short positions. And then that's the type of thing that could feed on itself, because the commercial buyers are out there. They're very happily just buying hand to mouth. As long as the market keeps going down, why should buyers buy ahead? Just keep buying, 30 days needs, 30 days needs, 30 days, and no point in buying ahead, because next month it's going to be cheaper. If you get to the point where you see fund short covering, that could also then trigger buyers who see corn as bargain priced to say, you know what? We've enjoyed watching the prices go down for quite some time. Now, if the funds are getting out, maybe we should start buying ahead. And you get that intensifying effect.
Is that kind of the opposite of what happened in cattle, do you think?
Exactly. The funds had gotten short, and all the cattle stopped going down, and that's all it took. There wasn't any particularly bullish news. Well, I'll take that back. The cattle inventory report gave a shot of adrenaline to the cattle market, and we'll talk about that in a little bit. But it was a reversal. The funds were net short in the meats, and then all of a sudden they started taking profits, getting out, and it was a self-fulfilling prophecy. As they were getting out of their shorts, they were making the market go up. And so while they saw the market going up, they're technically oriented. And so they just kept on buying to the point where now they're net long in hogs, and feeder cattle, and fat cattle.
Speaking of cattle, what do you see happening there now? What's the pattern that you're looking at?
Well, the pattern that we're seeing is that the trade has gotten, the bulls have gotten a second wind out of that cattle inventory report, because they had already bid up the prices considerably, but the cash market has sort of stalled. But then that cattle inventory report came out, and it showed the calf crop lighter than expected. It showed we haven't even started rebuilding the cow herd yet. And so the heifers held for replacements were well under expectations, and the calf crop was smaller to start with. So it really lit a fire under the feeder cattle market. And so the bottom line is we're in a cyclical bull market for cattle. And I think it's safe to say that we haven't seen the highs yet in that cyclical bull market for cattle, because you typically don't get the cyclical highs until you start tightening up the cattle supply even more. When people start putting heifers back in the cow herd, then that makes fed cattle supplies even tighter. And we haven't started doing that yet. So we haven't seen the bottom in fed cattle supplies. And until we do, the long-term trend is up. The cow herd, that's your beef factory, and it just keeps shrinking.
What kind of price targets do you set on the cattle based on the WASDE numbers then?
Well, the WASDE numbers came out, and they jacked up. They put out quarterly beef production estimates and then quarterly price estimates. And USDA raised their average price forecast a couple of bucks across the board. First quarter, they see first quarter cattle averaging, this is the cash cattle price, $176. We're already above that now. Second quarter average, they see cattle averaging 180 for the quarter. Third quarter, they see it averaging 180. And fourth quarter, they see it averaging 184. So they don't, the USDA, the WASDE numbers don't see the cattle market. They just see the trend up from now through the end of the year. And that's totally consistent with the pretend in beef production is down.
Now, did they have a different outlook when it comes to the pork side?
For pork, they raised the first quarter average to 55. It was 51 last month. For second quarter, they raised it to 62. Now, this is not futures prices. These are cash weight, live weight prices. 62. And for third quarter, they raised it from 65 to 66. And fourth quarter, they raised it from 55 to 56. So they raised the hog prices somewhat as well. If you look at the trend in pork production, they see it going down for second quarter, coming up a little bit third quarter, and then coming up fourth quarter. And so, logic would say, well, they see the pork production estimate going up, and that's why they see the average prices going down.
That's very interesting. Now, you have a direct line, don't you, that people can visit with you at Comstock Investments and talk about the situation here with marketing?
It's 314-348-8047.
I always appreciate talking with you. And And again, I want to encourage everybody, there's all kinds of information way beyond what we have just here on the video podcast. Dan is involved with putting out market information all through the week, and he has some just real detailed information that you can take advantage of along with others on the Comstock team. You can just go to comstock.com/report and check it out. You'll be glad you did. Also, by the way, you can subscribe to the Comstock Report for $1 for the first month, and check it out and give it a try. Dan, it's great to talk with you, sir. Thank you for all the help. Dan Manternach, he is with the Comstock Investments team, and we thank you for joining us here on our wrap-up of the WASDE Report for the February edition. For producer Brianne Hendrickson, I'm Marlin Bohling. We'll see you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget, you can also find us on Facebook and TikTok as well.